This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 3, 2026, and this is the New York session. Now, let's get into it. Shadow is dark, but the data is bright. As of 9:28 ET on this Friday, July 3, 2026, the global financial system is holding its breath. With U.S. markets closed for Independence Day, liquidity has evaporated, leaving a vacuum where volatility thrives. Gold is surging plus 1.2% to 4,175.82, while the U.S. dollar remains stubbornly supported by sticky inflation, pushing the Fear and Greed Index to a terrifying 14 out of 100. The yen is under siege. Dollar-yen is consolidating at 161.172, and traders are navigating a minefield of thin order books and stealth interventions. Let's look at the flow. Today is a unique market profile. There are no major U.S. economic releases scheduled for this Independence Day holiday. The next high-impact catalyst is not until Tuesday, July 7th, with the Reserve Bank of Australia rate decision. This means we are operating in a pure liquidity vacuum. What moves now is driven by residual overnight flows, algorithmic execution in low-volume environments, and headline shocks. We have no data to react to, only structure to navigate.
That lack of data is the variable. Normally, we wait for a Fed speech or a CPI print to anchor our views. Today, the anchor is missing. So we're looking at a market that is structurally leaning towards safe haven assets like gold and the dollar, simply because the alternative, risk assets, is being shunned by a crowd that feels extreme fear. We need to see where the bid is actually sitting when there's no new information to justify it.
Let's start with the headline that is defining the mood. Gold shines on the U.S. holiday, and dollar-yen consolidates at a key support after yesterday's suspected stealth intervention. These aren't just background noise. They are the active forces shaping the board right now. Pulse, you've been tracking the macro drivers behind this gold surge. Why is capital fleeing to 4,175.82? It's not just a holiday bump. It's a structural repricing of risk. The macro environment is locked in a sticky inflation paradox. The Fed is holding at 3.63%, while CPI sits at 4.17% and core PCE at 3.41%. Both are well above the 2% target. That means no rate cuts are coming anytime soon. When you combine that yield differential with a fear and greed score of 14/100, institutions don't want to gamble on growth stocks. They want the dollar. Look at the DXY leveraged funds. They are holding a plus 4,438 net long position. Even as the trade-weighted dollar index dips slightly week over week, the heavy money is still buying the greenback because the real yield spread hasn't collapsed. This is defensive positioning at its peak.
The pulse, you're ignoring the texture of the move. Yes, the macro supports dollar strength, but technically gold at 4,175.82 is staring down the barrel of the 5-day high of 4,195.57. We are only 19.75 pips away from that cap. The price action is rejecting that upper boundary repeatedly. Meanwhile, dollar-yen at 161.172 is hovering dangerously close to the intraday low of 160.921 and the 5-day low of 160.627. This isn't a clean breakout, it's a compression. The market is coiling. If we look at euro-dollar, the 5-day high of 1.14729 acted as a hard ceiling earlier this week, and we're seeing similar friction everywhere. Momentum is exhausted at these specific technical levels.
And that compression is the danger. You're both talking about levels, but you're missing the trap. The VIX is at 16.59. That looks stable, but it's deceptive. It's compressed below the 5-day high of 20.72, which means risk premiums are artificially low. In a holiday session with this much thin liquidity, a small shock doesn't move the needle gradually, it gaps. The Fear and Greed Index at 14 is extreme. Historically, extremes in low-volume windows don't lead to smooth trends. They lead to violent mean reversion spikes. The market is pricing instability that doesn't exist in the order book. We are one liquidity sweep away from a chaotic reversal.
So we have a clash between structural macro support for the dollar and gold versus a technical compression that suggests exhaustion, all amplified by dangerous low-volume conditions. Let's drill into the most fragile part of this board, dollar-yen. CIPHER, you own the flow data. What are the leveraged funds doing in yen?
They are screaming short squeeze, and that's why grid, you're seeing that compression. Leveraged funds hold a net short position of 97,092 contracts in yen. That's a week-over-week increase of 98,892 contracts. It is massively crowded. When you have nearly 100,000 contracts of leverage piled onto one side of a low liquidity book, you don't get organic movement, you get explosive reactions. The reason dollar-yen is consolidating at 161.172 instead of crashing is that every dip toward 161 is being met with covering orders. The algorithmic flow isn't selling, it's waiting for a trigger. Once that 161 psychological level breaks, it won't be a slow drift. It will be forced deleveraging across billions in notional value.
Which brings us back to my point on support integrity. The current spot at 161.172 is sitting just 0.172 pips above the intraday low of 160.921. That is razor thin. If CIPHER is right about the squeeze, then 161 isn't just a number, it's a firewall. But if it fails, we drop straight to the 5-day low of 160.627. The issue is that the market is refusing to give a clean direction. We're seeing consolidation, not breakdown. That tells me the short covering is absorbing the sell pressure effectively right now. The technical reality is a hold zone until volume returns.
Hold zone implies neutrality, but the fundamental driver contradicts that. The BOJ is facing immense pressure. Japan's wage hikes have topped 5% for the third year running. This is a fundamental shift toward normalization. Yet the market is still heavily short yen. This disconnect between the BOJ's inevitable tightening path and the current short positioning creates a structural imbalance. The stealth intervention mentioned in the headlines is likely the BOJ trying to manage this very imbalance. They don't need to hike rates to defend the currency if they can just prick the bubble of shorts. The macro narrative is shifting toward yen's strength, even if the chart looks flat.
And that's where the risk lies. You're assuming the intervention works smoothly. SPECTER here reminds you, when you fight the tape with intervention in zero volume, you create whipsaws. Look at the divergence in dollar Swiss. It's down minus 0.2%, yet leveraged funds are 13,816 net short Swiss franc. The franc is being sold off irrationally. If the risk-off trade unwinds suddenly, if that 14/100 fear score ticks up to 20 or 30, the Swiss franc bounce will be violent. We are not in a stable consolidation. We are in a loaded gun. The 161 level is a trigger, not a floor.
Let's pivot to the other major theme, the safe haven bid. Gold hit 4,175.82, up plus 1.2%. Apex, you've been watching the rotation. Why is gold leading right now, especially when equities are quiet?
Because gold is the ultimate hedge against the sticky inflation pulse described earlier. When the Fed can't cut due to 4.17% CPI, gold becomes the proxy for monetary debasement. But here's the synthesis. Grid flagged the resistance at 4,195.57, and CIPHER noted the liquidity vacuum. The result is that gold is approaching a liquidity grab zone. It's not necessarily launching higher sustainably. It's filling the void left by equity closure. We saw similar behavior in cable. It's up plus 0.16% to 1.33603, but the UK services PMI missed at 48.8. The fundamentals are weak. The price strength is entirely driven by leveraged funds holding a plus 7,567 net long position. It's a positioning error, not a fundamental truth. Same with gold. It's a positioning play against the dollar weakness, not a conviction buy at these elevated levels.
I'd add that the technical structure for gold is narrowing. The 5-day range is 3,942.2 to 4,195.57. We are at 4,175.82. That leaves very little room for upside before hitting that 4,195.57 cap. My floor is 4,123.3. Until we see a decisive break above 4,195.57 with volume, which we won't get today. We are essentially range-bound. The safe haven bid is capping out at resistance. Selling pressure is emerging at the highs, contradicting the idea that this is a runaway bull market.
That selling pressure is being absorbed by the same hands that are shorting yen. It's a rotational game. Money moves from equities gold dollar, but the dollar is being capped by the yen shorts. So you have a triangle squeeze. Equities are dead holiday, gold is maxed out, and dollar yen is trapped between intervention and shorts. The only place for overflow is into the crosses. Watch euro yen or sterling yen. The volatility will migrate there as the majors stall.
Interesting. So the majors are trapped, and the crosses might offer the only movement today. Let's look at the crosses. Euro sterling is at 0.856315. Pulse, you mentioned Eurozone services contraction. How does that sit against the pound?
The Eurozone is struggling. Services contraction eased but remains below 50. Germany's final services PMI is 48.6. France is trending down. Meanwhile, the UK services PMI is 48.8. Both are contracting. However, the pound is stronger. Why? Because of the positioning we discussed. The euro is shorted heavily, 15,410 net leveraged, while the pound is long, plus 7,567 net. The ECB is also caught in the inflation trap, unable to cut aggressively. So euro sterling is trading higher primarily because the euro is being unwound, not because the pound is performing well. It's a relative value trade based on short covering.
Technically, euro sterling at 0.856315 is testing the mid-range of its 5-day action. The 5-day low was lower, but the 5-day high wasn't explicitly flagged in the summary, though the general trend suggests consolidation. The key here is that neither currency has momentum. It's a choppy pair. If dollar-yen breaks, euro-yen moves. If cable breaks, euro-sterling follows. But standing alone, it's range-bound noise.
Let's touch on Aussie dollar. It's up plus 0.29% to 0.693575. Usually, a risk-off day kills the Aussie. Why is it green?
That's the anomaly. In a 14/100 fear environment, Aussie should be bleeding. The fact that it's up plus 0.29% suggests some speculative bounce or perhaps a correction in the DXY dominance. But look at the positioning. Aussie dollar is often a proxy for risk appetite. The lack of strong directional flow in Aussie suggests it's being dragged by the dollar's weakness against certain baskets. Or perhaps profit-taking on yen shorts is spilling over. It's not a strong bid, it's a lack of selling.
Don't trust the green candle. In low volume, plus 0.29% can be a trap. If risk sentiment flips back to neutral quickly, that Aussie gain evaporates instantly. The VIX compression at 16.59 suggests that the fear is priced in, but if the fear and greed index recovers even slightly towards 30 or 40, the carry trades reverse. Aussie is the first casualty of a risk-on rotation. Right now, it's just drifting.
We have one more major pair to address, dollar Swiss. It's down minus 0.2% to 0.80288. SPECTER, you flagged a divergence here earlier.
Yes, dollar Swiss is down, but the leveraged funds are 13,816 net short Swiss franc. Wait, if they are short Swiss franc, they are long dollar, so the funds are betting on dollar strength. But the price is dropping, or is the price dropping against the dollar? Let me clarify. Dollar Swiss is 0.80288, down 0.2%. That means the franc is strengthening against the dollar, but the funds are short Swiss franc, long dollar. This is a divergence. The smart money is long dollar, but the price is moving lower. This usually happens when retail or smaller players are selling the franc into strength, and the big money is absorbing it quietly. It's a hidden bid. The Swiss franc might be undervalued given the safe haven status. The drop is fragile.
Technically, 0.80288 is holding above the recent lows. The 5-day range is 0.80099 to 0.81202. We are closer to the bottom of that range. If SPECTER is right about the hidden bid, then 0.80099 is a critical support. A break below that invalidates the hidden bid theory and exposes the franc to further weakness. But currently, the price action is resisting the decline despite the bearish technical setup. That's a bullish sign for Swiss franc.
So we have a market where the obvious trades are capped, gold is hitting resistance, dollar-yen is fighting intervention, crosses are choppy, and the volume is non-existent. Apex, give us the strategic synthesis. How do we operate in this vacuum?
The strategy is defense. You do not chase breakouts. Grid's warning about the 4,195.57 cap on gold and the 161 floor on dollar-yen is critical. You treat these as boundaries, not targets. CIPHER highlighted the 97,092 yen short. This is the powder keg. If dollar-yen holds 161, the shorts remain trapped and we see consolidation. If it breaks, the squeeze accelerates. Given the holiday volume, a break is likely to be erratic. My read is to stand aside or use tight limits. Do not enter spot positions expecting smooth fills. For those positioned, tighten stops around the 5-day lows, 160.627 for yen, 4,123.3 for gold. And remember, the pound strength is a mirage, long positioning against weak PMI data. Don't let the chart fool you.
Agree. The macro backdrop, sticky inflation, Fed at 3.63%, supports the long-term dollar case, but the short-term liquidity vacuum makes trading unreliable. Monitor the DXY leverage positioning, plus 4,438. If those longs start to unwind, the dollar drops rapidly regardless of the holiday. Keep an eye on that flow.
And visually, watch the consolidation bands. If the ranges collapse, meaning the 5-day highs and lows get closer together, volatility will explode outward. We are in a coil. Breakout is imminent, but direction is unknown due to lack of news catalysts.
Just remember the VIX at 16.59 is a liar. It's suppressing the true risk. Size accordingly. One bad tick in a holiday session can wipe out a week's gains if you're oversized. Be ready for the gap.
Strong cautionary notes. To summarize our pre-market analysis as of 9:28 ET. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.